Welcome to our guide on the basic terms of business and commerce. Whether you're a student, a budding entrepreneur, or simply curious about how the world of finance works, understanding these foundational concepts is essential. In this video, we'll break down key terms that are frequently used in business, banking, and investment. We'll start with the basics, such as what equity and debt mean, and gradually move into more advanced topics like bonds, mutual funds, and important financial policy. By the end, you'll have a clearer picture of how these terms fit into the larger economic landscape, making you more confident in navigating business discussions or financial news. Let's begin our journey into the world of commerce. Now let's dive into some of the most fundamental concepts: equity, debt, and mutual funds. Equity represents ownership in a company. When you own shares, you own a part of the business and may receive dividends if the company makes a profit. Debt, on the other hand, refers to fixed interest-bearing instruments like bonds or debentures. Here, you lend money to a company or government and receive interest in return. Mutual funds are collective investment schemes where small investors pool their money, which is then managed by a trust and invested in stocks or debt instruments. The profits or returns are distributed among the investors. These concepts are the building blocks of personal and corporate finance, helping individuals and organizations grow their wealth or manage risk. Banking and finance are filled with specialized instruments and processes. For example, a zero-coupon bond is issued at a price lower than its face value and doesn't pay interest, but the profit comes from the difference at maturity. Regional rural banks (RRBs) focus on rural development, while lead banks coordinate banking activities in specific areas. Clearing is the process banks use to transfer funds when checks are deposited, and at par checkbooks allow for fee-free deposits across banks. Modern banking also involves tools like ATMs, debit and credit cards, and electronic money transfers such as RTGS and PayPal, making transactions faster and more secure. Understanding these instruments helps you navigate daily banking and larger financial decisions with confidence. Beyond individual instruments, financial systems rely on policies and market mechanisms. Terms like SLR statutory liquidity ratio and CRR cash reserve ratio dictate how much banks must hold in reserves, influencing liquidity and inflation. The bank rate is the rate at which central banks lend to commercial banks, affecting overall interest rates. International terms like LIBOR set global benchmarks for lending. In the stock market, IPOs, initial public offerings, FPOs, follow-on public offerings, and concepts like underwriting, book building, and lock-in periods shape how companies raise capital and how investors participate. Understanding these terms helps you see the bigger picture of how economies function and how policies impact markets. Wrap up: the world of business and commerce is built on a foundation of key terms and concepts. From understanding the difference between equity and debt to navigating banking instruments and financial policies, these basics empower you to make informed decisions. Whether you're investing, managing a business, or simply handling your personal finances, knowing these terms gives you an edge. Remember, financial literacy is a journey, and each concept you master brings you closer to confidently engaging with the economic world around you. Keep exploring, keep learning, and you'll find that the language of business becomes second nature.